Today on PFI Talks, I'm joined by Michael Bordo, one of the world's finest financial historians. Professor Bordo has spent his career studying the history of money, central banks, financial crises, and international monetary systems. His research ranges from the classical gold standard to the Bretton Woods era, all the way to the Federal Reserve's modern policy challenges. Few people can connect past and present as clearly as he can, and I'm excited to explore what history tells us about today's economic issues. Hello, Professor Bordo. Welcome to the Prague Finance Institute podcast.
Well, thank you very much for inviting me.
Before we delve into specific matters, let me ask a broad question. With your expertise in financial and monetary history, what strikes you most in the current economic landscape?
To tell you the truth, I find the current era extremely worrisome. It's really extremely worrisome. It in some ways it reminds me of the 1930s in terms of how worrisome it is, because the global order that was established after World War II. I mean, it was pretty successful. I mean, it was the backing, Bretton Woods and all of that was the backing, was the framework that led to the globalization, that what we call the second era of globalization. And I saw that as an extremely positive development. It led to the inclusion of most of the world in the international trading and financial system. It led to tremendous prosperity for much of the world. And I mean, one of the problems that we talked about when we had a conference on globalization 20 years ago at the NBR, and one of the issues that we dismissed, we talked about it, was, in a sense, the transition, the cost, the transition costs from people who were, in a sense, the losers of globalization, to those that were the winners. And we downplayed it, and we were wrong. That did play into the political debate, and it was there were a lot of similarities to what happened at the beginning of the 19th century and the end of the end of the 19th century and the early 20th century, which led to the demise of the first era of globalization that went back to the mid 19th century. So I see this as a big problem, and I don't know how we're going to get around it. This is something I was just at a high-level conference in Washington yesterday, put on by the Hoover Institution, and a lot of important people were talking about it. It's like, what's the world going to look like after the Trump administration? We don't know, and we're planning at Hoover. We're planning how to deal with that, how to make recommendations. But so I'm worried. I'm worried about the shift towards autarky. The shift towards nationalism. Nationalism always, to me, was a negative. Okay, I mean, I look at the 1930s, and that's just tells you how terrible things can get. And I wonder why people don't remember the past. That's the defining era in the 20th century, and we should be always thinking about how bad things can get. And so that is, yes, I'm very worried about it.
It connects with government debt as well. You've written extensively about the classical gold standard, which coincided actually with the first age of globalization. Keynes captured this beautifully in his The Economic Consequences of the Peace. That's a really nice book. Is today's retreat from globalization happening as rapidly as it did then?
I don't know. Okay, we 10 years ago after well, actually it's more than 10 years ago after the global financial crisis. The globalization really slowed down a lot. In fact, everything went into reverse for a while. And some of us at the time, not me, but a lot of us were very pessimistic. And I just thought that the benefits of globalization were still considered greater than the costs. And and in a sense, we started to turn around. I'm sure there were a lot of barriers to trade that were starting up all over the world, but we did turn it around, after about 2010. And so, in a sense, what's going on right now is kind of scary. And it's like we didn't really realize that the resentment and anger amongst the losers of globalization could lead to, politicians like Trump, okay, or like the guy that runs the country next to you, Hungary. I mean, we really didn't think that was going to come. Maybe the Hungary story is different because your history is different, but for the U.S., it was a shock to a lot of us, and we are trying to process it.
Yeah. When you observe President Donald Trump's attempts to pressure Fed officials into lowering interest rates, does this remind you of any historical episodes? I'm thinking particularly of President Nixon's relationship with Chair Arthur Burns.
Oh yeah, I mean, and I wrote about that. I mean, Nixon was. I'm not sure who was worse, Nixon or Trump. I mean, history will tell us. I was just watching the movie All the President's Men, because Robert Redford died, and I've been watching his movies. And when you read about Watergate and all that, you say, "Holy cow!" I mean, Nixon was a bad actor. Okay, and are we repeating that? But getting to your question, yeah. Nixon really pressured Arthur Burns to make sure that that monetary conditions would be easy, so that he would be guaranteed to win the next election. That he did that. There's a lot of evidence. I mean, like the day that Burns took on the job, Nixon pulled him aside and said to him, "Arthur, make sure that that you keep rates low for me." I mean, he said that in different words, okay? And later, when it seemed like maybe Burns was not quite following the plot, he used Haldeman and these other guys in his administration to put pressure on him, okay, about his income tax statements. So Trump does exactly that. Okay, he's going after people, and that's what Nixon did. And so Burns caved in, and he was really not a very effective central bank governor. Okay, I mean, they followed really terrible policies in the 70s, and it wasn't just Burns. Okay, Miller was pretty bad too. I mean, and it wasn't just pressure coming from the Fed, but they were following bad doctrine. Okay, these guys believed in cost push inflation. Okay, they did not believe that monetary policy could really control inflation. I mean, Burns was in favor of wage price controls, which was a disaster. And of course, Nixon imposed them, and they didn't work, and the other administrations did too. So the Burns episode is an extremely bad episode, and part of its being so bad is that the executive branch did pressure them, and that was definitely a serious cause of the way in which inflation got out of control. So that's the lesson. That's the worst case. I mean, I can give you other examples.
Yeah.
Okay, Canada, for example,
what's your view on Trump's attempt to remove Lisa Cook? Historically, it seems to me that presidents have typically waited until the end of officials' mandates, right? But Trump sought to fire Cook during her tenure. Is this the most concerning aspect of recent political pressure?
It's extremely worrisome, and many of us hope that the Supreme Court will deliberate on the side of Cook. But it's a major intervention into central bank independence, and if the Supreme Court goes along with Trump, this is very bad. Okay, it suggests that he will try with other people, and he will try to get rid of other people. He will put his people in, okay, and he'll put pressure. There'll be more pressure coming in on the FOMC. Okay, I mean he can't do anything to Powell. Okay, Powell will have to sit out his term, but it could make it very difficult. And you could have people who are voting because they want to please the president. I'm not sure they're gonna do that. Okay, my general feeling for most of the members of the FOMC, especially the Reserve Bank presidents, is these guys are really serious. They're serious. Most of them are serious economists. They look at the issues, okay, and I don't think that they are driven by politics. Okay, I might be wrong on some of them, but I'm quite. I think they're doing a reasonably good job. They make mistakes. Okay, I think they just made a mistake a few days ago. I think they should have kept interest rates high because inflation is the major problem. And because by cutting like they're doing, they are accommodating the Trump tariffs. Okay, when you don't want to accommodate something like that. That's a supply shock. Okay, you don't want to do that. You don't want to because by doing that you justify it and you remove the pain that is coming from declining output and rising prices that would actually lead to a backlash amongst the public. So Trump is pressuring them to save his neck, and I think I was dead opposed to that.
Public debt levels today are ordinarily high. Trump also has contributed to it. Looking at historical episodes such as Britain after the Napoleonic Wars or the US after World War II or Latin America in the 1980s, what conditions typically determined whether such debt burdens were sustainable? Can you make a comparison to the current period?
Oh yeah, I mean, a key factor in maintaining macro stability is to have sound fiscal policy. And the history of fiscal, and I worked on this in my UK paper, is that it was called the Treasury view, which is you run deficits during emergencies like wars, but you always run it down. So what happened? The emergency was COVID, and the U.S. and other countries did probably the right thing. Okay, they may have gone too far, but when you do that, if you believe in the Treasury view, which is sound fiscal, then you try to reduce deficits afterwards, and they aren't doing that. Okay, and so what happens is then you get into a different regime, called fiscal dominance, which is a regime that the Latin Americans perfected, okay, but also has happened in other countries. It happened in the UK, as we talked about in the 1960s, and then you run into the risk of a debt crisis. Okay, and that depends on how the rate of the interest rate relative to the growth of the economy, etc.
Do you see any signs of a debt crisis approaching, coming to the U.S. or other countries?
Okay, so what worries me? Okay, I have this idea. It's this, it's called the Wily Coyote moment. It's from this 1970s and 80s cartoon show where you've got the roadrunner is this bird, okay, that runs very quickly out in the western part of the United States, and he's being chased by this fox, okay, and then he goes off a cliff, but he's a bird, he can fly. Wily Coyote follows him. Okay, and and then suddenly he looks down and he realizes that he's no longer connected to the earth and he falls. Okay, and so my thing is there's a moment, we'll call it a Wily Coyote moment that's out there. It happened to the Truss administration in the UK and the US. It could happen to the US. For example, if things go bad for Lisa Cook and the bond markets really believe that the Fed will be dominated, we will have the U.S. will go in the direction of fiscal dominance. I could see there being a speculative attack on the dollar, and I could see bond prices and the bond market vigilantes getting to work, pushing up long-term yields, in the U.S., and that's a big problem. Okay, whether it'll lead to a downgrading of debt for sure. Okay, now getting to the Latin American, the Argentina world, I don't think the U.S. is going to be there, but the U.S. got into big trouble back in the 70s.
So
Okay, in the
do you
70s,
mean, given the current geopolitical tensions and actually COVID-induced spending, do you believe we are entering such another transformational period?
I'm worried about that. Okay, unless they can come up with a way, to raise enough revenue to service the debt. And also, of course, they've got this problem that the U.S. and all the other countries advanced countries have gotten themselves into, where they cannot politically cut the entitlements. Okay, so right now, what's Trump's doing? His game is to use tariff revenues and to argue, look, we're servicing the debt. So what he's doing is he's imposing a major long-run cost on the economy, which will lead to lower potential growth, which will make it harder to raise the revenue in the future. Okay, and he's using an inefficient revenue mechanism we discarded that mechanism, okay, in 1913 when we put in the income tax. So it's a retrogressive tax, okay, and so that temporarily is going to make it look like it's not so bad, but the markets see through this. They see the inefficiencies.
But the markets have been really complacent. They don't see this option. They don't want to admit.
Right, and there's a lot of questions about that. So one answer is, you've got technological progress. Okay, we've got this big tech boom that's underway, and AI, and so there's this bet that people are making that this will raise growth enough that this will obviate the problem. So you won't have that problem where the interest rate R is greater than G, the growth rate, because the growth rate's going to go up. So and so the markets have not yet realized that there could be a tech bust. And my work on financial crises, okay, and asset price boom bust says there's a very good chance that we're going to have a tech bust, okay? And we had one in 2000, okay? And the same kinds of arguments were being made back then. We were in a new world of new technology, et cetera, okay? And we were, but it took a long time, and there was a huge shakeout, okay, of the tech firms. So that could be the moment. Okay, the Lisa Cook thing could be a very bad thing. So there are a lot of landmines out there that could trigger a fiscal crisis.
Do you think that we are definitely living turbulent times? Like from the panic of 1907 to the 2008 financial crisis, we can trace common features. Credit booms, you just talk about them, inadequate regulation, and now cryptocurrencies, speculation even. So are these the patterns, worrying patterns you see today?
Yes, I mean, we have this, the crypto thing is definitely worrisome. I mean, it hasn't been that big a deal because it hasn't really, moved over to the real economy. Okay, I mean, the whole crypto world is they're all betting on each other, but it hasn't leaked into the real economy. But see, the Genius Act, okay, that's pushing stable coins in the U.S. So I'm working on a talk I'm going to give on next week on that at Hoover, 2 weeks. But there are poison pills in there because there are things that aren't clear about these stable coins and their backing. Okay, and I think that could lead to a problem because what they're going to be used for, what they're used for right now, is to basically finance the crypto space. And I'm not convinced there's any reason for the crypto space. It doesn't do anything. I'm not convinced except it finances illegal activity. And there is a lot of illegal activity. Okay, so the black sector might be 10 to 20% of the world, and that's what crypto finances. And now stablecoin's going to get tied in with that. So that could leak back and affect the real economy. So yeah, that's a problem. I see that as a systemic risk issue.
So it seems to me the crypto has been for investors a favorite thing to invest. So if there is not real outcome, a real use of the cryptocurrencies, is it just a big bubble? Is it a new gold, as people say? Will it replace the dollar in the long term?
I don't believe any of that. Okay. I mean, look, I see digital currencies as a financial innovation, just like paper banknotes were an innovation over gold coins, and they can be the stable coins. Bitcoin is definitely not a financial innovation, okay, because its value changes all the time. So it was a substitute for gold, okay, but we knew how the gold standard worked. It was based on a fixed price of gold. Okay, and Bitcoin. So those types of assets I can't really see a value for, but stable coins could be a technological change which could make payments more efficient. They could facilitate cross-border payments, etc., and they could be an improvement on money. But the key thing is they have to be properly regulated.
They are
Okay,
not.
what we learned from history was in the U.S., the free banking era was a disaster because of bad regulations. They created national banks in the Civil War, and the national banknotes were pretty safe. Why? Because they came up with good regulations. So, it can be a force for good because it's an innovation.
So do you mean CBDC, the central bank digital currencies?
Well, so that's a different question.
Is the crypto an inspiration for the CBDC, or how these two phenomena are linked?
Yeah, so here's the deal. I mean, yes, so the technology, the blockchain technology, et cetera, that could be is a good way that could lead to CBDC. CBDC is basically a digital version of cash. Okay, and I think I've argued, I've been a big fan of it, and I argued that if it's done right, and if you get the banking system involved in a partnership, that it would make a much more efficient system. Okay, but what's happened in the States is they don't want it, okay, because of this myth that this would destabilize the banks. So they're pushing stable coins. And stable coins, if they're regulated properly, can do a lot, okay? But what they can't do is a CBDC can deal with a lot of public good issues, which stable coins cannot.
Monetary policy, especially.
It could be used for monetary policy, exactly. And that was what I argued with Andy Levin. And you could use the interest rate on CBDC as your policy tool. Okay. But that argument, which we made, we were one of the very first to do this. We made this argument, but it's been sort of put aside, largely for political reasons, because the banking system feels threatened that its rents will be reduced greatly, okay, if we had a CBDC. And then there's all these other arguments about the government would be, using CBDC as a way to take people's privacy. But I think these things could be worked out, and I'm still optimistic for it, but I'm not optimistic for the U.S. and for Europe. So the digital euros, I think it's a good idea, but they've hobbled it. They put in all these restrictions because they're worried about the banks. And so it's not going to really do what they want it to do, except maybe make the payment system more.
Can it help the euros, the digital euro, help to expand the euro area, to help it to establish the euro as a reserve currency?
In theory, it could, okay, but given that they've constrained it, okay, they don't want it to bear interest, and I think it should bear interest. Efficient money should bear interest. Okay, they've limited the number, the amount that can be held. Okay, and so because they've done that, it's not going to do that much. Okay, I think that it could definitely improve the wholesale market. And that's a big deal in Europe because your payment system is not that good. So it could help. Okay, but I think you'd have to really go farther than they've gone. And also they're worried, the Europeans are worried about stable coins coming in, and
Yeah.
capturing the market. And the Americans, of course, actually want to do that. So that's a problem right there. And so
Will the dollar maintain its position as an international reserve currency?
uh, at present, it looks like it. And one of the reasons, well, okay, there are these negatives out there. As I said, all the policies the Trump administration's been following in the growth of nationalism and movement towards autarky and trade, and then some of the ideas that are out there by Mr. Murin, to actually reimpose capital controls, etc. Okay, all of those things are negatives. Okay, but yet the dollar is still pretty dominant. And why is that? Because there's no alternative, and because they built this network, the network effects of using dollars have developed over many decades, and they're still the most useful form of invoicing, and they're the most useful currency for international transactions outside the U.S. And so we don't have an alternative. The euro is not there yet. Okay, it could be. You could say, yeah, Europe is about the same size EU as the U.S. Its economy is smaller, but not that much, et cetera. It has deep financial markets. It has rule of law. So it has all the preconditions. But you've got one big problem in Europe, and you guys have stayed out of it, and that is you don't have a fiscal union.
Yeah.
Okay.
Yeah.
So this is until they can figure that out. Okay, if they could become what they really wanted to do at the beginning.
So you wouldn't recommend to join the Eurozone at the moment?
No.
To anyone?
The euro is good for the European, Europe. It's fine. It's good for transactions. But outside of Europe, the dollar definitely has a lot of advantages still. However, as I said, if these policies that the Trump administration has been putting in, if they really keep doing the damage they're doing, okay, that's going to reduce the dollar, and it means you're going to get more regionalization. And so you'll get in East Asia, you'll get, the Chinese currency. If they also get rid of some of their capital controls and restrictions, they could dominate in East Asia.
You mentioned the option of U.S. Introducing capital controls. So in the late 19th century, capital moved across borders relatively freely.
Yeah.
Are we moving towards a more fragmented financial era?
I think so. I mean, it's like once you open the Pandora's box of nationalism and the Pandora's box of mercantilism, okay, and once you realize, which the Trump guys are thinking about, but they haven't got there yet, that it's not just the balance of trade, but it's the balance of payments, and they start focusing on that, okay, then they're going to realize that maybe they want to start controlling, where the dollars are going and who's bringing the dollars in. And so, I mean, as I said, Mr. Murin has come up with a plan to sort of to move back in that direction. And other countries, I mean, China has capital controls. Yeah. I could see other countries thinking, oh, well, maybe we have to, add this to our toolbox. Okay, so all the bad things that were developed in the 20th century, okay, all the bad stuff, exchange market intervention, tariffs, capital controls, all the things that were worked out in the 30s.
You are using now.
Okay, are coming back now. And what people don't realize is how bad they all were. Okay, so like my work, my whole life has been showing what the benefits of free markets are, in finance, in goods, everything. And these are being rolled back, okay, for protectionist, nationalist, okay, populist reasons. And we know where that went in the 1930s. That's exactly what happened.
Yeah.
It was a disaster.
You're currently working with Ned Prescott of the Federal Reserve Bank of Cleveland on how ideas from regional Federal Reserve banks influence the U.S. monetary policy. That seems to me really interesting. Do ideas spread like financial crises, or is the mechanism of intellectual contagion fundamentally different?
So what we're looking at is, and we have a book project, and we've done a fair amount of work on that, and we're arguing that when you have a federal system like the states, where you have these different sources of power, okay, that can actually be useful because you've got different ideas that are competing with each other, okay, and in a sense it's a contrast with the ECB, which is sort of like that, but it's much more centralized. Or the Bank of England, which are centralized, and so you find that ideas tend to be coming from the top. And so what our work has shown that there have been historical cases where new ideas in economics have come in through the Reserve Bank. So two examples that we've done a lot of work on was in the 1960s with the Great Inflation. The monetarists under Milton Friedman and Carl Brunner and Alan Meltzer, etc., they had a lot of influence on the St. Louis Fed. And the St. Louis Fed was pushing the importance of monetary aggregates. Okay, and this took a lot, and they were contrary. And the board in Washington didn't really disapprove of what they were doing. But as the Great Inflation took hold and things got worse, they began to listen until eventually they did listen to them. Okay, and then the second case we talk about is the Minneapolis Fed. And there, the Minneapolis Fed was hooked up with the University of Minnesota, and there was a lot of basic research done on rational expectations. And so the rational expectations model and all the work that came out of that leading towards, monetary rules, rules over discretion, and the importance of information, all those ideas, in a sense, came through Minneapolis into the board, and a lot of them were adopted over time. So we document that. We're also looking at the credibility issue, and that comes from Richmond. We're looking at banking and how some of the bank reforms that occurred in the 70s and 80s and 90s came in through the Chicago Fed. So it's talking about how ideas can be processed in a kind of a corporation which has different branches.
Do you see any interesting ideas here in the regional Federal Reserve banks?
So what's happened, and again, this is an historical study, so it really goes from the 50s until the present. So we think that things have changed. There's been much more homogenization of ideas. Also, what's happened for various reasons is the board has put more control over the reserve banks, okay? And so they don't have the power that they did back then. And the third thing is that ideas are they come in from all directions, because communications have improved. Okay, so new ideas come in, and they come into the board, they come into the, they move much faster. And so we don't see this as quite as prevalent an issue as it was back then. That's not to say that it could be improved upon, and so we are advocates for maintaining autonomy and independence for the regional feds, giving them the ability for new ideas to come and for new sources of information. Okay, and right now the Fed's been moving in the other direction. So we agree with you that I don't think it's quite like it was, but I think it should be like it was.
So maybe to wrap it up, the closing question. If you were to distill one lesson from monetary history that policymakers constantly overlook, what would it be?
Okay, the most important thing is, there are a number of, the most important thing is to maintain stable money. Okay, that means to preserve the value of money. And to do that, you have to be credible. Okay, to be credible, it means you have to follow policies that are consistent over time. Okay, so you have, in a sense, you need a rules-based framework that's dedicated to maintaining price stability. Okay, that's my approach. The ECB follows that approach, and I like that approach. I don't like the dual mandate. I think that introduces politics in. Okay, it's always led to trouble. And so the most important thing is to maintain price stability is credibility. That's what's most worrisome. Okay, that's the big issue today that's facing all central banks, but it's really scary in the U.S. because the U.S. is the richest country, it's a dominant currency, et cetera, et cetera.
Yeah.
So you got to get back to stability. Swiss National Bank figured it out 100 years ago. The Bundesbank figured it out in post-World War II. And those are the models that I think we should be thinking about. Then there's all the other stuff, lender of last resort. Yes, you have to do that. But you shouldn't do anything else. I have very strong views. I don't think they should get involved in climate, equity, any of that stuff. That's not central bank stuff.
Yeah.
I'm a very I'm a very conservative person on these issues.
That was PFI Talks. Thank you, Professor Bordo, for joining us in Prague.
You're welcome.
And thank you for listening. See you next time.